Okay, numbers seem to stabilise. So, welcome everybody. This is 30-minute masterclass on the accounting basics, understanding your accounts. My name is Rob Krupa. I'm a director here at Menzies, and I'll be talking you through this topic today. Now, given this is a 30-minute masterclass, we probably won't have enough time for a Q&A session on this. Some people have asked some questions in advance, which I've tried to cover off in the presentation. But if you've got anything as we go through, if you want to pop them in the chat, either myself or the team will come back to you afterwards and try and cover off anything you've asked. I will say there are quite a few slides here, some with quite a bit of detail. So this is being recorded and you will receive a link to the recording afterwards. So if you'd like to watch it back, that is fine. We weren't intending to send the slides out themselves, but as I say, given that it's recorded, you can just jump in and go to whichever bit you want to look at. So in terms of what we're going to cover off today, our topic areas are these here. So the basics in terms of what accounts are and why we do them, elements of the accounts, so the basic format and things that are included within them, interpretation, so how to understand the accounts, and this is really a key area in terms of why we're doing this bit today, because understanding the numbers is quite important. Accounting policies, so what they are, what choices we can make and how that might influence the accounts and therefore the interpretation that comes before it, and then the impact on tax. Now, this isn't going to be in any great level of detail, it's just one or two points to consider on that, because tax is a big subject, as I'm sure you all know. So I can't cover all those elements today. So if we move to the basics. So what are accounts? So accounts are essentially a set of statements presenting the financial performance of a business for a period of time and a financial position at a specific date. Now, that'll be more clear in a moment as I run through the other slides, but let's just put this into context a little bit in terms of why we prepare them. So as at the end of September, the Companies House record shows that there are 4.8 million companies and LLPs on the register in the UK. Now, all of those are required to submit some accounts in some shape or form annually. And to June 21, the statistics show that there are 4.3 million self-employed people in the UK, and that includes partners in partnerships. So what this means is there's a total of 9.1 million sets of accounts that need to be prepared every year for some reason or other. Now, that said, this is a legal obligation, but there's arguably a more important reason to prepare your accounts, and that is to make better informed business decisions. So if we can understand how we're performing and what we've done in the past, we can use that information to make better decisions going forward. So in order to do that, we need to understand the accounts and what's included. So to help with that, we're going to move over and look at some of the elements of the accounts. So first off, we're just going to look at some types of accounts. So broadly, you could categorize accounts into three areas. So you've got non-statutory accounts, statutory accounts, and management accounts. Non-statutory accounts are going to be those year-end accounts for those unincorporated businesses. Now, with those, there isn't a specific layout that you're required to follow. For the tax man, for HMRC, what they require is that you prepare your accounts on UK GAAP. So GAAP is generally accepted accounting principles. And I'll talk a little bit more about that in a moment, because I'm going to just cover off some accounting standards when we get to that bit. Statutory accounts are those that are required to be prepared by companies and LLPs, so they will go to Companies House. Now, this is a lot more strict in terms of what you're required to present. So the formats and content is laid out in legislation via the Companies Act and in the accounting standards, which are the UK GAAP. There's a minimum set of disclosures that you have to follow, and there's little flexibility in that. You can choose to present more in those accounts, but you typically can't present less. And one really important thing to remember here is that there is an element of these that is a public document. So your accounts go on public record. This means anyone can go into Companies House and look at those at any one point in time. That's important because what you present in the accounts could influence their decision making, could influence their view of your business. And when we get into the interpretation element of this presentation, you'll understand why that becomes more important. So the management accounts, these are for internal use. Sometimes they go external, so if a bank requires to see information or something like that, then they may do, but typically they're for the management of the business to make decisions. There's no set format in terms of what you present here. You can put whatever you like in there. It's really important you include specific KPIs that are important to the business. And again, we'll talk a little bit more about that as we get through. Now, as all three of these are different, they will contain different elements. There's different formats and content, but they all contain some very similar basic elements. So they will typically all include a profit and loss account. Now this is called an income statement in your statutory accounts. They will typically have a balance sheet or a statement of financial position, and then they'll have some supporting notes. Now, supporting notes in statutory accounts, as I've said already, that's laid out in legislation and in the UK GAAP and the requirements set down there. So there'll be minimum elements you put in. But in the management accounts, this could be anything that you like. It could be whatever is important to the business, whatever you use to measure the business. In statutory accounts, you will also see other statements. So you'll have a director's report. In medium companies and larger companies, you'll also have a strategic report, probably a cash flow statement. You may have something called a statement of total recognised gains and losses, and there could be other statements as well. Now, these all have their individual purposes, and they present information for a particular reason, and they're not all required all of the time. What we're going to do in this bit, we're just going to look at the two main statements that we show in accounts. So we're going to look at the profit and loss account and the balance sheet. Before we do that, what we're going to do is just cover off some of the UK GAAP elements, some of the statutory elements of the accounts. So in the UK, the vast majority, sort of 95% of our accounts are covered off by these two accounting standards. So these accounting standards cover off what need to be disclosed in the accounts, but also quite importantly, how you treat transactions. So the accounting standards will put in the recognition and measurement tools that we present our numbers with. And those two main standards there, as you can see in dark characters to the side, we've got FRS 105, which is for micro entities. And you can see the turnover and gross asset limits there are quite low. So these are for small businesses. And then you've got FRS 102, which is used for small, medium and large entities. And this is one standard that covers all three. Now that said, small entities are able to use section 1A of the standard. And what this does is massively reduce the amount of disclosure that you're required to put in the accounts. Medium companies also receive some exemptions, but not that many. Large entities don't receive any exemptions from disclosure as set out by the standard. Now, I'm not going to read through all the size requirements here, but essentially the measure between where you sit is you have to satisfy two of those three criteria to use that set of standards. So for small companies, you would need to be turnover of no more than 10.2 million and gross assets no more than 5.1 million and no more than 50 employees on average. If you breach two of those thresholds, then that means typically that you move up to the next stage. So you might wonder why this is important. Well, the first thing is that disclosure is a really important thing. So as I've said already, your set of accounts is a public document, it goes on public record. So what you present in them gives more information about your business. So if you can reduce your disclosure requirements, that might be favourable for you. And the second one is that actually these thresholds tend to align with the audit thresholds for the UK. So when you hit those medium company thresholds, typically at that point, you would also need a statutory audit. In the UK, we also have other accounting standards, so we can use IFRS, and there are different versions of that for small companies as well, or that's not as widely used, but that is used by listed entities and some other types of entities where they don't qualify for other criteria within these. So what we're going to do now is just look at some of these statements. So we're going to move over to the income statement to start with. So this is what a typical income statement might look like. This is quite a simplified version. There might be more lines in there in bigger businesses. But what we're going to do now is just pick out some of the key elements in here. So if we go back to the start of the presentation, I mentioned that the statement covers the financial performance of a business for a period of time. So an income statement covers the profit and loss you've made, so the performance over that period of time. Typically, this is going to be a year, and you're required to present them annually unless you change from year in for some particular reason. And what I'm going to do is just talk through some of these headings. These will be familiar for many of you, but for some they might not be. So I'll just briefly skip through these. So our turnover is our income generated in the period on an accruals basis rather than the cash basis. So this isn't when you get paid, this is when you raise your invoices. And there could be some quite differences between those two elements. Also importantly, this excludes VAT. So if you're VAT registered, VAT isn't an income for your business, so that doesn't appear in your turnover. If you're a non-VAT registered business, however, it would be included. But obviously a business of this size in here, they would be VAT registered unless there's a particular reason not to be. Gross profit is your turnover less your cost of sales. Excuse me. Cost of sales are, as it's suggested in the name, those costs which are directly incurred as a result of making a sale. So you have to incur that cost to make the sale. I've got some examples of this further on when we talk about accounting choices, but so I won't cover that in too much detail now. Our admin gross profit, sorry, I spoke about that one. Our admin expenses are indirect. So typically that could be things like rental, rental for a property. It could be staff salaries for admin staff that aren't directly linked to a sale. Operating profit is another key measure in our profit and loss account or income statement. So this is the trading activity of the business with all income and all expenditure taken out. So I say all income because actually there is some other income that might not appear in turnover, but might appear above that line. Now this is typically before interest and financing transactions. Profit before tax is also termed net profit in many cases. So if you hear the term net profit, that's this line here. So that is all of your income and all of your expenditure excluding the corporation tax. Your profit after tax is obviously after you've taken that tax charge out. And this is what's left in the pot to distribute to shareholders or owners of the business in the majority of cases. Now there are some exemptions to that or exceptions to that. So if you've got a business that has investment property, for example, you might see a fair value gain go through the profit and loss account, but that wouldn't be a distributable profit, but it would still appear in profit here. So if we just move over to the balance sheet, we'll just take a quick look at this one. Now this is very loosely based on the statutory format because actually what is included in a balance sheet wouldn't actually nicely fit on this page. So I'll cut this down and I'll simplify some of the headings here. But again, if we just talk through some of these headings for you. So your fixed assets are those assets which the business purpose is, purchases for ongoing use. So this isn't something you're just going to use for a year and then discard. This is something that's going to last for a longer period of time. Current assets are assets of the business which are going to be used or recovered within a year's time typically. So this will include things like your stock, your trade debtors, and any cash balances that you might hold in the business. Creditors within 1 year, as the sort of terms state, are your payments that you're going to have to outlay within the 12 months of the balance sheet date. So the balance sheet is sort of a snapshot in time in terms of on that year-end date, these are all your assets, not your liabilities. So the creditors due within 1 year are within 1 year of that balance sheet date. And this can be supplier balances, short-term loans, taxes such as VAT, PAYE, corporation tax, all those other elements that you'll need to pay out of the business. So your net current assets is an important measure on this. So that's your current assets less your current liabilities. And it's a good measure of whether the business can satisfy its creditors within the short term. So if that figure is negative, it means you've got more current liabilities than you have current assets. Moving down to your creditors due after 1 year. And typically this is going to include things like loans, hire purchases, those liabilities which are due for payment in an over 12-month period. Now this isn't the full value. So if you've got a loan that is, in this case, £300,000 and £250,000 of that is due after 1 year, then it's the 250 that appears here, not the full value of the loan. The element due within 1 year would appear within the creditors due within 1 year. So the loan would be split in the accounts. Net assets is all of your assets less all of your liabilities. And this again is a good measure of solvency of the business. So if that's a negative number, it means that essentially you don't have enough assets to settle all the liabilities. Now that's not always the case, because if you think about how this value works, you've got all of your long-term liabilities here, but your current assets might be generated from your trading. So it might be that actually that measure isn't as important to a particular business. So it's just one to be careful of. That said, the net assets figure should be if you sell all of your assets at the book value and you collect all of your debts at the book value and you settle all of your creditors at the book value as shown, that is essentially what you would have left in the pot for distribution to shareholders. Now the second half of this balance sheet is your capital and reserves element. So the balance sheet does balance, as you see, you've got that 1.9 million sat at the just sort of 2/3 of the way down, and then again at the bottom. So your capital and reserves will always balance with your net assets. So in here, typically you've got your share capital. You may have other reserves. So if you've got revaluation reserves, they might sit in here, or reserves for other specific reasons. And then you've got a profit and loss account. Now I've got a question mark as to distributable here, because as I mentioned in the previous statement, there will be some profits recognised that may not be distributable. So it might be that you have elements in here that you can't distribute to shareholders. And then that final line there, so the total capital reserves, that's also termed shareholders' funds. So if you hear that wording, that relates to this number here. So what we're going to do now is we understand the basic format of the accounts and what's included in there. We need to move forward and look at our interpretation. So we're going to look at two key areas here. One is the key performance indicators, or abbreviated as KPIs, and then trend analysis. So all of these can be gained from the actual statements themselves. So I'm not going to talk through all of these, but what you've got on the screen here is a number of sort of traditional accounting policy ratios, and also termed KPIs, key performance indicators. So these are the ones that you can actually get from the statements themselves, so from the profit and loss account and from the balance sheet. These are grouped together in how they measure the business. So it might be that they measure profitability, efficiency, liquidity, or solvency. Now, in many cases, these won't be reported in the accounts, and certainly for small companies, it would be unusual to see these in the accounts. Medium companies and large companies, you would see some of the factors of these being included within the strategic report. And the ones that are included are those which are key to the management. And just to help you and differentiate between liquidity and solvency here, because they are very similar, but liquidity looks at the ability of the business to settle its current liabilities. So i.e. those things that appear in the due within 1 year element. Solvency looks at the longer term. So this looks at your long-term liabilities as well, including your loans, your hire purchase, and any other long financial commitment that you might have. The really important thing on these KPIs is to understand what is important to the business. Every business is different. Every KPI will impact a business different ways. If you're a manufacturing business, your KPIs are going to be quite different to if you're a service provider. So it's important to pick out the ones that are important to you, important to your business, and give you a good measure of where you are and where you're moving forwards. Now, in management accounts, you would see a lot more than you've just got here, and you would pick out ones that are really specific to the business. So the KPIs don't need to be these traditional accounting measures. It might be that you're looking at sales per employee head. It might be that you're looking at a percentage of leads converted, if you measure that information. It could be a number of members that the business has. So if you work on a subscription model for your income, it might be that you're looking at machine hours. It might be staff utilization. It could be anything that is important to you, so you can get a measure of how the business is looking. And of course, you might be a completely unique business and have a completely unique KPI that you see as important. And that's the sort of thing you want to put in your management information. Now, I mentioned just before this about looking at trends as well. So what you want to do is not only just measure these KPIs in the moment, but actually look at them over a period of time. Now, how has our gross profit moved over the last 3 years? Is it going in the right direction? Is that going up? Is it going down? We also need to look at the interlink with other KPIs. So it might be that your sales are improving, which is a good thing, but it might also mean your debtor days are going up. So that it means it's taking you longer to collect your debts. So in terms of using that information to make these better business decisions, you need to judge there whether there's a decision that could be made or should be made. So do we need to put more effort on recovering those debts? Do we need to employ someone to do that? Really figure out from these KPIs and the trends in which they're producing, what is that decision that's going to be made? And that's the real benefit that you're getting from these. So as we've looked at the formats and briefly skipped over the interpretation there, what we're going to do is just look at some accounting policies and how these might influence the accounts. So what we're going to do is we've just got some real basic examples here, but first of all, I'm just going to look at what an accounting policy is. So an accounting policy is a method of calculation and the principles applied to compile the financial statements. So examples of accounting policies could be revenue recognition. So how do we recognise our revenue? At what point can we say that something gets included within sales in the profit and loss account? It could be depreciation. What policy do we use? Do we depreciate over 3 years straight line? So we recognise 1/3 of the cost of the asset every year until it gets down to 0. Or do we use a reduce and balance method? where the asset reduces in value heavily at the start, but then slows down over a period of time? Are we actually looking at a revaluation policy? Therefore, every few years, we revalue our assets and state them at what we deem the market value to be, or the recoverable value to be, depending on what measurements we're using. That also feeds a little bit into asset recognition. So when and how do we recognise an asset on our balance sheet? And then how do we measure that going forward? So our valuation methods. So do we need to revalue our assets? Do we need to do we need to measure our assets differently? What method are we going to use to value them? So as I've said already, accounting standards will provide the basis for many of these. And in a lot of instances, there aren't any choices. You have to do what the standards say. But however, there are some options in there. So this middle element here, so the management of the business can choose the most appropriate accounting policy. Where you've got that choice, you need to think about how that's going to impact on the business, but also what that's going to present. Is that a true and fair view? The accounts must always present a true and fair view. And in the statutory sense, the accounting standards and also the Companies Act require that the directors sign off, or the members sign off in an LLP's case, to say that the accounts present a true and fair view. So what we're going to do now is we're just going to look at 3 accounting policies or accounting choices that we've got. So these are really straightforward choices, really straightforward examples, but actually they're useful for us to be able to highlight how they impact on the accounts. So we're going to look at capital versus expense to start with. So whether something that we've purchased or whether an expenditure that we've incurred is a capital item or an expense item, and how that impacts on the profit and loss account and how it impacts on the balance sheet. Second one is looking at depreciation methods. I've already touched on that, so I'll go into detail of that. But also whether a cost there is a sales cost or an admin expense. Now this doesn't sound like it's a very important definition to make, but actually when we get to numbers, you'll see why it is. So capital versus expense to start with. So we've got a really straightforward example here. So we've got a business that's going to spend £2 million on development over a 2-year period. They're going to spend £500,000 in their first year, and they're going to spend £1.5 million in their second year. Their pre-turnover business is all development expenditure. You know, their first option is to put that cost through the profit and loss account. So what we can see here is in year 1, we've obviously got a loss of £500,000. In year 2, we've got a loss of £1.5 million. This is financed by way of a loan. So what we've got on the balance sheet here is we've got a liability of that £500,000. We've also got a net assets position of minus £500,000, which is our profit or loss for the period to date. Now in year 2, our balance sheet, we've got a total liability of 2 million. We've borrowed that 2 million, so that's 500 in the first year and 1.5 in the second year. So our net assets position, because it balances off, is minus 2 million. What the management of this business, though, might have an option is to capitalise that expense. So what we're going to do is just look now at how that might change the figures. So if we ignore depreciation or amortisation on that expense, and we say that all of this cost can be capitalised, what you've got there is a stark difference in the profit and loss account. So you're not recognising any loss at all in that period because there's no expense going through. It's all being built onto an asset. So when we look at the balance sheet there, we've got in year 1 a total of £500,000 sat as an asset for the business. We've still got that loan, we've still got that liability there, but as they balance off, we've got net assets of 0. And in year 2, obviously both of those figures are 2 million, given that's the position to date. Now what you can see between the blue tables and the green tables there is a massive difference. And again, the question might be here, well, why does this matter? Well, it depends what your business is doing going forward. Depends who's looking at the accounts. So in the green example there, when you've capitalised it, it might appear to be a more financially stable business. It might be more investable if you're looking for external investment. It might be that if you're looking for funding from a bank or some alternative source, actually that looks like a more stable business. Whereas when you expense it, it might not. Now you have to meet the criteria to be able to do this, but if you've got the option, it's definitely worth looking at that and seeing how that might influence the accounts and how that might influence people that are looking at the accounts. So our second example here is to look at the depreciation method. Now, depreciation itself isn't necessarily an accounting policy choice, because this one we're looking at methodology here in terms of how we depreciate, but it is still a choice that the management of the business can make. So we've got a £500,000 asset again in this instance, and what we're doing is we're depreciating over a 3-year period. So what we can see from year 1 here, we've got 1/3 of that £500,000 recognised as a cost in the profit and loss account, being the depreciation on the asset. So our balance sheet, we've got the total asset being the 500 less that 167. So we've got an asset of 333,000. We've still got that loan though of 500,000 because we've not repaid that. So we've got net assets of minus 167, which is our loss for that period. Now in year 2, we've spent another 1.5 million. So we've got a third of that, plus an additional 167 being the second year of the asset that we developed in year 1. So our loss for the year is 667,000. Now our assets are obviously all the costs to date, less all depreciation to date. And we've still got a liability of 2 million. So we've got minus 800,000 deficit on the balance sheet. But how will that change if we look over a 5-year period? So if we say, actually, there's a justification here to say that asset isn't just going to last 3 years. We think our development is going to last for a 5-year period. How's that going to influence our accounts? Well, it brings our cost down because we're spreading that cost over a longer period of time. So we can see here in years 1 and 2, we're recognising only £500,000 in total across the 2 periods. Now our balance sheet improves again because of this. So our asset is inflated, not inflated, but is held higher because we're not depreciating it as quickly. Our liability stays the same because that loan is what it is. But what we can see there is at the end of year 2, our net assets position is minus £500,000 compared to a minus 834 in a 3-year depreciation method. So again, why is this important? Same as the first reason really, first example really, that it depends who's looking at the accounts. What you need to make sure again that you do here is make sure that's a realistic method for your accounts. What you don't want to do here is just wait till your accountant prepares the accounts at the year end and let them choose the accounting policy because that's typical for what they know. Actually, it needs to be really important for you and your business, particularly if you're in a niche area. What you could also do actually is adopt a revaluation policy. So what you could do is rebase that cost to a market value every year. And what you'll be doing there is removing your depreciation for the most part, and you'll be increasing your asset value. That's not a straightforward thing to do. If you've got fixed assets such as plant and machinery, vehicles, things like that, that's more easy to do because you can get a market value for those. If in this instance, you're internally developing an asset, that might be harder to do. So the measurement might be really tricky, but it's worth speaking to your advisor about to see if there's an option there. The final example here we've got is cost of sales versus admin expense. So again, I said when I started this bit, well, why would that be important? And we'll see that now. So we've got turnover here, excuse me, in year 1 of £500,000. Turnover in year 2, 600,000. We've got some cost of sales, we've got some gross profit, admin expenses, and a profit before tax at the end there. We've spoken about these already, so I'm not going to go through what these are and what these mean. But the key bit we're going to look at here is this cost of sales. So actually what we say is in that cost of sales, we've included something that, thinking about it, should have been an overhead. It's not directly linked to a sale. So directly linked would be if you're a reseller of equipment, you know, you buy that equipment, you put your markup on it, you sell it on, that equipment appears in cost of sales. But it might actually be, there's some labour costs in here that aren't directly linked to that. They actually do an admin task, therefore they shouldn't be in cost of sales. So what we're going to say here is if we take £100,000 in year 1 and £120,000 in year 2 and represent those as admin expenses, what will our accounts look like? Well, what you'll notice instantly there is that the bottom line doesn't change. So your profit before tax remains the same because all we're doing is allocating between cost of sales and admin expenses. Our turnover doesn't change, but what does change is our gross profit figure. So in our first example, we've got £200,000 and £250,000 gross profit. In our admin cost example there, we've got £300,000 and £370,000. Now what you see in the little tables at the bottom is how that influences our gross profit margin. So if gross profit is a key measurement for our business, or KPI, then we need that to reflect the real situation. So we've got, in the first example there, 40 and 42%. whereas in the second example there we've got 62%. That makes a huge difference. So if that is the situation, if that's the way that you should be presenting, then that's the way that we should go. But what I would say is, don't just do that for the purpose of presenting a figure that you want to see. And that's the 3 examples. What I'm just going to do really briefly now is just talk about tax. So actually what you would think in most cases is, oh, our profits go up, our tax go up. So our profits go down, our tax go down. That sometimes can influence what people do in their business and the accounting choices that they make. But it shouldn't do. Not all changes influence tax. Depreciation, for example, isn't a tax allowable expense. So if you're looking at your accounting policy on depreciation, you shouldn't think, oh, I'll depreciate quicker because I'm not going to pay as much tax, if that is a driver for you. Same with capitalising assets. Whether you capitalise an asset or expense it through the profit and loss account doesn't necessarily change your tax position. It might be that you still get tax relief on that asset, and in many cases you will. Certainly at the moment, as annual investment allowances are sitting at quite a high value. What you've got to do is make sure that you're making the right accounting decision for the right purpose and for the right reason, rather than to influence your tax position. Now, what I would say with all of these is speak to your advisor, speak to your accountant. Don't let them make an assessment at the year end. Be engaged in it, speak to them about it, present your accounts, in a favourable light, but in a realistic light. Going back to that true and fair point, you need to make sure that they present a true and fair position. Have that discussion with someone. So what we're going to do now is, of the topic areas that we've covered, we're just going to put a quick poll up. So the poll is, I would like to find out more about. You're given 3 examples here, or 3 options, sorry. I think you can pick multiple as well if you like. So it could be that you'd like to find out more about choosing a different reporting regime or the impact of that. How to better interpret the financials in your business, or how the impact of the change in accounting policy might have on the financials. So I'll just give a few seconds there for you each to take to select answers. Okay, so thank you for participating in that. What we'll do is, with each of you, we'll try and follow up if we can afterwards in terms of what you might like to hear more about. So finally, for me, I would just like to say thank you for watching, for listening. As we've said at the start, this is a recorded webinar, so this will be available. You will receive a link to this webinar following the recording being finalised. It will also go up on our website if you want to look back at that at future times. So thank you very much for watching, and goodbye from me.